Hi, I'm Pete Andresen with Andresen & Associates, and I'm sitting here at the office with a two-headed Llama, or at least a two-headed Llama candelabra. One has to wonder what the artist was thinking. And it actually has something to do with today's discussion. Today we're going to talk about valuations. What's driving my concern about valuations, as always, is that historically, high valuations lead to low returns, and low valuations, in other words, buying something cheap, lead to higher returns. Basically, valuations in the stock market are determined with statistics such as price-earnings ratios, so it's not like they're hidden somewhere. Americans and people all over the world tend to engage in manias, and so what happens is that a lot of the time people buy high and sell low, which is the opposite of what you're supposed to do. You're supposed to buy low and hopefully keep it. Selling high is not a bad second option. My concern is that the stock market is back to choosing what is overvalued and ignoring what is inexpensive, when historically what is inexpensive, if it was quality to begin with. I mean, trash is cheap. We don't want to buy trash. Finding quality, inexpensive investments is a big deal. Today in Barron's, we had an article, the dot-com bubble peaked 23 years ago. The NASDAQ has barely beaten inflation since then. Basically, what that's saying is that the NASDAQ, that's technology, 23 years ago was at a high, and since then it's done 1% better than inflation. So all that, think about everything we've done in the last 23 years, all that fancy stuff, all the technological innovation, investing in that, if you invested back 23 years ago, has produced 1% over inflation. Investing in what was cool and hot has essentially produced a pretty marginal return. Now, there's two ways to look at this article, and I'm going to put the link in the comments down below, but there's two ways to look at this article in Barron's. It's by Mark Hulbert, and Hulbert does good work. This is good stuff, so Mark Hulbert wrote this. But the first thing is that it's a bit of a statistical anomaly because stocks are down right now. This would not have been possible, say, a year ago. A year ago, tech was doing mighty fine. The point here, though, is that success is not always guaranteed, and less guaranteed if you buy expensive investments. Now, the second comment here is that valuations matter. They matter. Boy, do they matter. And the core value to take away from there is what is hot, what is cool, what is sought after is usually overvalued. Historically, over the long term, it usually doesn't deliver above average returns. Isn't that bizarre? What is a wonderful idea or a wonderful company may not make a good investment, and that's really crucial. So, a successful, overvalued investment in real estate or stocks is about as common as a two-headed Llama. And that's why the two-headed Llama's here. You don't see very many of those, do you? And you don't see very many 20-year returns that are really stellar with overvalued investments. Now, you're going to come back to me and you're going to say, well, Microsoft. And yes, you'd be right. But way back when, Microsoft was cheap. So I'll leave you with that thought. This is why we continue to avoid investing in high value stuff. We continue to watch out for those valuations. We're continuing to tilt small value and international a little bit. And that's what's going on. So remember the two-headed Llama. Thank you very much. Stay warm and blessings.